The S&P 500 is up, but 40% of its stocks are actually down more than 20% from their 52-week highs. Think about that for a second. We're in 2026, and you're seeing headlines about record highs, but dig just a little deeper, and the picture looks, well, complicated. This is the breadth paradox in action. Back in 2022, during that aggressive rate hike cycle, we saw something similar. The S&P 500 might have only been down 7% from its peak, but Morgan Stanley reported that half of all listed stocks were already down 20% or more. What does this mean for someone looking at their own portfolio in this uneven market? How do we make sense of a few megacap stocks pulling the index up while so many others are struggling? We're going to break down how this happens and what lessons we can draw from history. Did you know that in some market environments, the S&P 500 can be up, even as more stocks are going down than up? It sounds like a riddle, but it's a very real phenomenon that's been playing out in different forms for years, and it's something every investor needs to understand. This isn't just some academic theory. J.P. Morgan strategists actually highlighted this in 2023, observing that a narrow set of stocks can sometimes power the entire market forward, even if the majority of companies are struggling. Think about the S&P 500, a broad market index. You'd probably assume that if it's rising, most of the 500 companies within it are also rising, right? Not always. For example, back in 2022, even as the S&P 500 was down roughly 7% from its January high, many individual stocks were experiencing much steeper losses. Morgan Stanley data at the time showed that a significant portion of the market was already deep into bear market territory, even with the index's more modest decline. This divergence, where the overall index masks what's happening beneath the surface, is what we call the breadth paradox. The lesson here is that simply looking at the headline index number can be misleading. It's like judging the health of an entire forest by only looking at the tallest trees. Today, we're going to break down exactly how this happens, why it matters for someone in your situation, and what historical precedents can teach us about navigating these tricky market conditions. So, what exactly is this breadth paradox? At its core, it's a situation where the overall market, like the benchmark S&P 500, can show robust positive returns or be steadily rising, even when a significant majority of individual stocks within that very index are actually declining or suffering substantial losses. It's akin to witnessing the Boston Celtics clinch the NBA championship, yet discovering that only Jason Tatum and Jaylen Brown were consistently performing at an elite level, while half the roster was sidelined with injuries or struggling with poor form. This directly challenges our traditional understanding that a healthy, sustainable market advance requires broad participation, meaning most stocks should be experiencing upward momentum. However, the empirical data tells a more nuanced story. We've observed distinct periods, going all the way back to data from Ned Davis research in 1996, where the S&P 500 climbed despite more stocks declining than advancing on any given trading day. Consider the market dynamics in early 2022. The S&P 500, as an index, was down roughly 7% from its January 27 all-time high. But behind that seemingly modest dip, many individual stocks, especially smaller cap growth names and speculative tech, were experiencing much more significant pain, often down 20%, 30%, or even 50% from their peaks. Analysts like Mike Wilson from Morgan Stanley were actively calling this out, noting how exceptionally concentrated the market's performance had become, with just a handful of megacap technology firms driving the bulk of the returns. The critical lesson here is that an index headline, though widely reported, doesn't always accurately reflect the underlying health or widespread participation of most companies. This phenomenon isn't a fleeting anomaly, it's a recurring pattern, indicating that a narrow set of dominant stocks can heavily influence overall market performance, masking broader weakness. This brings us directly to the elephant in the room: narrow market leadership. So, what's often driving this paradox? It's the elephant in the room: narrow market leadership. Picture this. The S&P 500, with its 500 companies, is designed to represent the broader U.S. stock market. But what if only a handful of those companies are actually pulling all the weight? That's exactly what happens during periods of narrow leadership. A small number of megacap stocks, think your Apple, Microsoft, Nvidia, Amazon, start to disproportionately influence the index's direction. These market giants, with their massive market capitalizations, can literally mask underlying weakness across the broader market. The headline S&P 500 performance might show, say, a 10% gain for the year, but if you peel back the layers, you could find 60% of the constituent stocks are actually down, some by 20% or more. It's like the Boston Celtics clinching the NBA championship, but only 2 players actually played well all season. Everyone else was struggling. J.P. Morgan strategists, back in 2023, highlighted this exact phenomenon, noting the dominance of a select few stocks was creating this kind of skewed picture. They showed how a handful of market leaders could keep the S&P 500 afloat, even as many other companies were struggling with rising interest rates and slowing growth. This isn't a new concept, either. Lowry Research, on November 7, 2018, argued that market leadership is not synonymous with market breadth, illustrating how a few all-star players often dominate, which is narrow by definition. The lesson here is that a rising tide doesn't always lift all boats, and looking only at the S&P 500's headline number can be misleading for an investor's own portfolio. This brings us to when the paradox really bites. Market divergence explained. When this paradox bites, it creates a serious market divergence that can be incredibly misleading. Imagine the S&P 500 appears healthy, maybe even up slightly, but then you look at your own diversified portfolio, full of great companies, and you're thinking, wait, why am I not participating in this rally? Well, that's the danger. Many individual portfolios, especially those diversified outside the narrow leaders, can be significantly underperforming the benchmark. Morgan Stanley analysts highlighted this recently, noting that the S&P 500 might only be down roughly 7% from its January 27 all-time high, yet a substantial number of individual stocks could be down much, much more significantly. We're talking 20%, 30%, even 40% drops for companies that aren't part of that megacap elite. It's like the overall water level in a lake looks fine, but many individual boats are slowly sinking. This divergence can create a false sense of security, or lead investors to completely misinterpret the overall market strength. You hear about record highs, but for many, it doesn't feel like a record high. The lesson here is that market averages can hide a lot of pain. This phenomenon creates interesting opportunities for active managers who can identify undervalued stocks outside the narrow leadership, but it also poses risks for passive investors who might be unknowingly overexposed to just a few concentrated areas through an S&P 500 index fund. Understanding this nuance is key to navigating periods where the market's headline performance doesn't tell the full story. Beyond breadth, we need to unpack other market paradoxes that often go unnoticed. But the breadth paradox isn't the only time market behavior can seem completely counterintuitive. Investors often encounter other perplexing situations, each challenging our assumptions about how markets should work. Take Simpson's paradox, where a trend within different data groups disappears or even reverses when combined. Edward H. Simpson described this statistical phenomenon in 1951, with real-world implications for market data interpretation. Consider an accuracy competition. Saturday ***, you solve 7 of 8, 87.5%, your friend 4 of 5, 80%. You're ahead. Sunday ***, you solve 2 of 2, 100%, your friend 1 of 1, 100%. Still looking good. Combining totals. You solve 9 of 10, 90%, your friend 5 of 6, 83.3%. It appears you won. This example illustrates how aggregated data can tell a different story than individual data points. The lesson is to always look at the underlying data, not just averages or combined totals. Then there's the rate hike paradox. Michael A. Gade, CFA, observed in May 2016 that markets posted 8 straight weeks of positive returns despite a 70% probability of a Fed rate hike. This defied the conventional duration playbook, which often suggests rising rates are a headwind for equities. The market's reaction to anticipated events isn't always linear or predictable, news may already be priced in, or other factors are at play. Understanding these paradoxes is crucial for making sense of today's market, highlighting why blindly following headlines or simple metrics can lead you astray. So, how do we navigate a market that often seems to defy conventional wisdom? What you need to know is: so, how do we navigate these paradoxical markets? The first step is to look beyond those headline index numbers. If you're only glancing at the S&P 500 up 1% on a given day, you might miss a crucial part of the story. Instead, someone in your situation could benefit from examining market breadth indicators. These are like an investor's blood pressure gauge, as Joe Mazzola, head trading and derivatives strategist at Schwab, puts it. They tell you the true health of the market. Think about the advance/decline line, which tracks how many stocks are going up versus down. Or the percentage of stocks trading above their 200-day moving average. When Krinsky coined the breadth paradox, he was highlighting that sometimes the S&P 500 can be rising even as decliners outnumber advancers, a trend historically unusual since 1996. This means a rally might be riding on the shoulders of just a few megacap stocks. The lesson here is: relying solely on the S&P 500's performance can lead to skewed expectations for your own diversified holdings. Your portfolio, full of solid companies, might not track the overall index if its strength is concentrated in a handful of outliers. It's crucial to analyze market trends critically. Don't be fooled by frequency data alone. The lessons from Simpson's paradox, where trends within groups vanish when combined, apply here too. Understanding this paradox allows us to make more informed decisions, perhaps adjusting our strategies to account for narrow market leadership rather than being misled by a seemingly robust overall index. So, what's the big takeaway here? It's that the market is often a story of layers, and those headline numbers, whether it's the S&P 500 up 1% or down 7%, don't always tell the full tale. The real health of the market and the performance of most investors often hinges on the collective participation of thousands of companies, not just a handful of giants. Understanding the breadth paradox means you're not just a passive observer of the S&P 500's ups and downs, you're equipped to dig deeper, to ask why the market is moving the way it is, and to better manage your expectations when the rally feels out of reach. Have you ever looked at the news and seen the S&P 500 making gains, only to check your own diversified portfolio and wonder why you weren't seeing similar returns? Drop your story in the comments below. I'd love to hear about your experience with this paradox. If you want more breakdowns like this, where we expose the hidden mechanics of the market, make sure to hit that subscribe button. And if you're curious about how individual stock performance can diverge wildly even within the same sector, my breakdown of the dot-com bubble's Nifty 50 stocks is exactly the next thing you should watch.